Hello, Tom Lavecchia here with the latest edition of the New Theory Podcast. Today we have a returning guest. His name is Darwin Roman, fellow Jersey guy, fellow Rosa Parkian. Shout out to Rosa Park. And he is the life insurance mercenary, a proud, and we should be proud to thank him for his service as U.S. Marine. Darwin Roman, welcome back to the New Theory Podcast. How you doing today?
I'm doing fantastic. If I was any better, I'd be twins, Tom. Thanks so much for having me on here again. It's good to be back for sure. It's good to see you again. And tell you what, a lot of crazy stuff has happened since the last time I was on this podcast, right?
Yeah, I was going to say the world has changed. So you're kind of noticing a little bit of a shift in the podcast. We're kind of getting to more how-to, a lot of stuff for business owners, a lot of stuff for individuals, stuff that you may or may not need, not just getting some, big time guests on, which is pretty cool to do, but we're having regular people like Darwin and me on the podcast. So COVID kicked us all in the nuts. Let's call it what it is, right?
Yeah.
And I want to make sure. I'm 45. I got 3 kids. I do have kids from a previous marriage. I got a new kid, a new fiance, getting married, and things are a little crazy in terms of, God forbid, and I'm not in the healthiest shape right now. I got problems. So I want to know, let's start off for guys and gals in their 40s, and then we'll kind of work at different age ranges, or is a plan a plan? I want you to start road mapping for our audience, if you will. When we start thinking about life insurance, especially in lieu of COVID, how should we start thinking about it, and what is the first step?
Sure. So whenever I talk to somebody with regards to figuring out the right amount of life insurance, that's the biggest question, because I typically come across some people that may already have something in place. And I usually ask, well, how did you come up with that number? And they usually don't have an answer as to why they have $250,000 or why do they have $500,000 of coverage. The second part to that question is, what do you want your policy to do for you? And then they also typically don't know how to answer that question. So to be able to answer both of them, number one, how do you come about with the right amount of life insurance? There's 3 targets that I talk about specifically with my clients, and we'll break them down in this way. So target number one is looking at how to replace your income in the event you're no longer here, right? Now, there's a lot of different ways or different ideas of how to go about that, but there's a general rule of thumb that makes it simple in the sense of replacing your income is at least 5 to at least 10 years worth of your income to be replaced. Okay.
Hold on, Darwin, because I'm a numbers guy. What if I have a 6-month-old, 8-month-old, rather, 8-month-old, an 8-year-old, an 11-year-old. So I'm thinking I wanted to go beyond 18, but let's just stick with 18 for now, right? Mm-hmm. For each of them. And on top of it, stupid question, but is it gross income or net income? So I want to go through that.
Right. Sure. So we're using gross income for now, but the beauty of it is that, let's say, for example, I'm talking to someone who makes $100,000 a year for mathematic purposes, makes it simple. $100,000 a year multiplied by 5 years, that's $500,000. Now, granted, $500,000 in life insurance proceeds will be tax-free. So when you think about it from a perspective of gross versus net, the net death benefit will be much higher than the gross income. So which is great, which is fine, still works. Got it. Yeah, but then we look at, so that's income replacement. The second target, actually, you touched on it right now with regards to children, is that a lot of times I'll say, well, how many kids do you have? And you want to make sure that the college education is protected. So when it comes to that part, I'll put it in the perspective of saying, well, you have 8-year-old, 11 and 8 months old, right? So right now it'll be hard for you to say, well, how much will college be in the next 5, 10, 20 years? Who knows, right?
I got to put $500,000 on all 3.
But what I put in perspective is say, all right, it's hard to predict what tuitions will be like in the future, but let's pretend that it was today. So I say, what if all your kids, Tom, tomorrow, all were about to go to college, and let's pretend that we're about to go to King University. And let's just say that King University is around $25,000 annual tuition.
Yikes.
Right? Let's just say it's that. Let's just say, for example, or Rutgers, for example. We'll use Rutgers, for example. So, it's better off we use Rutgers.
That's
so,
right. Did you go to Rutgers too?
No, I went to Kane.
Okay.
But let's say Rutgers, right? So you talk about Rutgers, that could say definitely a $25,000 annual tuition, right? 2 semesters, $25,000. So we're looking at 3 kids, and in 3, now 4 years of college per kid will be $100,000 today. So we want to make sure at least protect what the today dollar would be. So in that case, it will be 100 times 3, which is now $300,000. So if a person owns $500,000, that's one target. The target number 2 is college education protection. In this case, 3 kids times 100 grand. That's 300,000. Now we get $800,000 of coverage. Yeah. Then we look at the other stuff, which is the asset protection. And then it's very common right now, especially with the boom in the real estate market, which I work with a lot of realtors and mortgage lenders, and whether they refinance.
Wait, hold on, Darwin. Before you go over to asset protection, I want to keep it simple because the tagline to this is going to be, do you need health insurance? I'm sorry, not health insurance. Do you need life insurance? And I'm with you now. So right now I'm at 800K in my head, right? Mm-hmm. And I have the pleasure of having a great fiance, and I would want her to be somewhat protected too. So I would want her to have at least, I'm making this, let's say, sake of argument, I want to have $500,000 net till, if I expire, right?
Right.
So now I'm at 1.3. Now, do I look at, before we get to asset protection for a second, do I look at it and say, okay, hey, in my will, I'm going to have a net worth of X and then backfill it with insurance? Or do you recommend, no, Tom, if you need 1.3 million, your assets are great. No matter how much you have, still give them 1.3 on the safe side. Do you deduct the assets from that calculation, or do you just go with the grossed up number and the assets are just a benefit for your beneficiaries?
Well, when I look at assets from that perspective, like assets versus insurance, because that's also, that's another calculation when it comes to life insurance. Because some people will say, first we say, what would act like life insurance in your life? And then from there, see where the gap falls, right? But in this case, we're reverse engineering it. But when it comes to your assets, like let's say you have assets too on the side outside of your life insurance contract, when that's totally fine too. You can keep them separate because your life insurance contract will be a standalone contract. You notice they keep using the word contract. It is a contract because it's a legally binding agreement between you, the insured, and the life insurance carrier. And basically stating that as long as you pay your premiums every month, the agreement is that the life insurance carrier will pay the overall death benefit. In this case, you're talking about $1.3 million. And you are also the owner of the contract. So the contract has a couple of parties, but you're actually more than one party and representing itself. You're the owner, you're the insured, and you're the payor, right? You're 3 of them. So you as the owner also have the right to be able to add beneficiaries or remove beneficiaries as you see fit, and also designate what percentage of benefit those beneficiaries will be entitled to in the event of your expiration, like you said. So although you can have a will to designate what kind of assets will be distributed, let's say with regards to your estate, the life insurance contract will stand alone too. So whatever you decide, that life insurance company will honor post-mortem, right? After you're no longer here, they're going to honor that too. So it's you'll be able to have both of them pretty much at the same time.
Okay. So hold on. So then another question is for the audience to learn: the whole life versus term life, like the $38, but if I die, I get $1 million, but you don't get anything, but I give you 150 in 30 years, I get 200K. Walk me through, like I'm at 3 years old, between the term life and whole life.
Right. I like to talk about the biggest differences between the two and how to classify them.
Yeah.
So every time I have this question, I use a very simple analogy that I've been using now for a couple of years, and I relate it to real estate. So let's say, for example, term insurance is like renting an apartment.
Yeah.
And I talk to people who I was like, now renting an apartment is not a bad thing because you have a place to live, sleep, eat, it provides shelter, right? The next worst thing after that, or worse, would be homeless. So having an apartment is a good thing. You have a place to live. Yeah. But eventually it's a lease-based situation. Over time, the lease will expire, right? And then I talk to my realtors and say, what's the biggest objection or the biggest idea with regards to a renter trying to become a homeowner, right? So renting is like term. You have a place to have protection, but it's for a certain term of time, 10 years, 20 years, 30 years. After that time, it expires, right? Now, that's one part, term. The next part is permanent insurance, which is what you said, and that whole life. And it comes in 2 different subcategories. permanent insurance breaks down into either to whole life or universal life, one of those two. But the concept of permanent insurance is different than term. Reason being is because as opposed to renting, you're actually owning. So what happens with permanent insurance is that the difference is also what you're contributing to that contract to make it permanent insurance. And I'll give you an example is that when people tell them to ask me, well, how much is $100,000 whole life, right? And then typically they ask that question, or just how much is whole life? How much does it cost? And I tell my clients, it's not so much cost versus contribution, because cost is term for sure. Term is pure monthly cost or annual cost for the amount of life insurance. But when it comes to permanent insurance, you're looking at contribution, because your permanent insurance typically ends up being more of a strategy that people want to use to build a long-term asset. Because
so keep going. I'm sorry, keep going.
I was saying, because like buying a home, right? A lot of times a person going from renter to owner, when it comes to real estate, their biggest fear is like, my God, now I got to come up with a big down payment. I got to worry about maintenance on a house. They're seeing more out of pocket costs, so to speak, into buying a home. But we know that there's value in buying a home, because over time, paying your mortgage, you have to fix it up. You have, right? You said the word, you building equity over time. A permanent insurance contract will behave in a similar fashion, because although you will be putting more into that contract over time, number one, you're owning it. Number two, you are building equity, although in insurance terms, it's called cash value.
Okay. So, let's say sake of argument, I sign with you tomorrow. I'll give you $150 a month. I'm betting I'm going to live to 65, right?
Right.
20-year term.
Sure.
If I die, I get beneficiary gets $250K. But if I live, I get X amount of dollars, right? Why not just go to a mutual fund or stock market or something else where it's like, like you're just structuring a fancy mutual fund. Now, with a mutual fund, if I kick, I don't get anything. But for now, I'm kind of betting I'm going to live. So why do that over a mutual fund?
I wouldn't say do it over, because I also ask with regards to somebody's, what's their strategy and also what's the risk tolerance.
Got it.
Right. So if you're looking to minimize your risk, obviously a mutual fund is the way to go, right? Mutual fund has a lot more risk as compared to a permanent insurance contract. Now, what's the benefit of a mutual fund? You have a lot more gain possibly, right? Than an insurance contract, because they're two different things. They're two different breeds. One's an investment, one's insurance. And that's also something that I always come across too, is like, permanent insurance, whole life is not an investment. I said, I agree. It's not an investment. It's not supposed to be an investment. All right. Investments have risk. Whole life doesn't. That's the difference. Investments have a lot of gain. Whole life doesn't. That's the difference. But then why even bother? Well, the thing is that if you want to minimize risk, well, there could be a strategy within your portfolio. If you're looking to use tax-free income on the cash values, that's also a strategy in your portfolio.
A way to get more from it. Okay. So Darwin was on before, and I'll put a link. He was a great guest before. You get his background, that kind of stuff. But kind of before we wrap it up, I want to COVID, right? Which is a pandemic. It's an atypical thing that happened, right? And I trust you. Because I trust you, but I don't trust insurance companies. And be candid, be as candid as you can.
Yeah, sure.
Has there been any COVID, it's an atypical event, it's a pandemic, an act of God, yada, yada, some bullshit that not to pay people out. So, and if so, before you get to that, if you're worried about that, when you get your insurance policy, is there certain language you want to make sure you have in there to protect yourself? So can some of these companies kind of jimmy around it because it's COVID? And B, if I'm signing up for a policy, I want to make sure this includes everything.
Exactly. So prior to COVID, life insurance contracts already included natural death.
Okay.
And when you think about a virus, if you were to die from pneumonia, that's natural. You can't escape that. If you happen to contract HIV during the life of the contract and you die from HIV, that's just a virus, right?
Yeah.
So, and I was also seeing last year, a lot of people on Facebook started to bring that up, and some people were actually misinforming in the sense saying, hey, by the way, just to let you know, COVID-19 is not covered in your contract, not covered in life insurance. Right. And then I said, that's a good question. So if I got my policy last year, if I got my policy in 2017, how could a life insurance carrier have ever written the words COVID-19 in the contract in 2017? That'd be impossible. Viruses are covered. What is COVID-19? It's still a virus, right? Yeah. So with regards to them paying claims, what will happen is that if the policy is within the first 2 years, they can always contest the policy. That's in any policy, and that was pre-COVID-19. Nothing different there.
Does it happen often?
Well, within the first 2 years, sure. I had a client that got cancer, and it went to the contestability period. Now, just because they contest it doesn't mean they're going to deny it, but they do.
Wait, while somebody's alive or after they kick?
Actually, I had somebody while they were alive because it was a contract that had a living benefit in it, a critical illness rider. So they were able to use the life insurance while they were alive to help pay for medical expenses.
That's like a long-term disability type thing.
It's a rider built into the policy. Okay. So they were going to use that rider, but
that's my point though. If I freaking give you an extra $50 a month and I get cancer, I want that money.
Sure. And that's the area that that's the area that we look at. So we want to make sure we get the right policy to cover all those areas, right? But I was saying in this case is that they went through the protocol of doing the contestability, whether a person would have died or cancer with this policy would have been the same process. And it took 3 months, but after 3 months, the company did pay the claim on the cancer claim. So my client received a lump sum tax-free to help pay for medical expenses. A lot of people did pass away during COVID, obviously, unfortunately. A lot of times also people had life insurance already. And if they did have life insurance already and had it for a while, and they were also truthful in their application, a lot of these life insurance companies have been on the hook for it. So
with shutdowns and stuff, we're seeing a lot of loneliness, depression. I'm guessing suicide is not covered typically, correct?
Suicide is not covered during the first 2 years.
Got it. Okay.
For after 2 years, because then after that, they can't say that, well, we knew you were under depression, so we're going to exclude it. I'm out of nowhere, 3 or 5 years from now, somebody just decides to blow the brains out. I mean, nobody could see that coming.
Good point. Good point. Yeah. Good point. Spoke like a true Marine. All right. So we're going to conclude soon, but a few more things came up because I love talking to you. The other thing is in terms of, like let's say you're buying insurance for yourself or for somebody. I just get worried about like, well, you didn't ask for this, or you didn't bring this up, or that death rider, give me some of the quick verbiage. Obviously use Darwin if you can. If you're not in Jersey, you're not in the area, and let's say someone in Kansas, what can somebody say to themselves so they don't get fucked when they sign up? Like, what are some of the terms you ask for? No, I'm serious because I get worried. Like for example, like I didn't even know or think to ask for a sickness rider. You know what? I'll pay the extra $50. God forbid I get sick and can't provide. So, what do you recommend somebody going into one of these policies? What is the verbiage, or what do you recommend they say when they go in?
Yeah. So you know what? And also, people should know exactly what these companies are looking for.
Yeah.
So the 3 major factors: number 1, your age; number 2, your gender; and number 3, your health. Right. Obviously, you're not going to lie about your age. You're not going to lie about your gender.
Stop smoking.
Right. But your health, right? Smoker versus non-smoker, any medications. You also want to be as truthful as possible when it comes to that, because here's the thing. I've had clients even with me that try to get over on the system. And I had a client claim they were a non-smoker, no health issues, right? Come to find out they were a smoker and they were diabetic and they had blood pressure and they had COPD.
Right.
And what happened is that we went through an application. He got approved, had the policy for 6 months, but understand that these companies from time to time will audit these policies and double check all the info. And come to find out, this particular client was lying. Look, people unfortunately do try to beat the system. And he got caught. They rescinded the policy, refunded his premium, but now he has no life insurance. Now, he could apply more, but because he was trying to save money on his policy. Now he's going to have to face the truth of what it really costs for at his age with his conditions, life insurance. And now at this point, he doesn't really want to do it. I said, well, that's okay. Don't do it, because really if it's not in your budget, then you can't do it. What can we do? So being as truthful as possible is the way to go, because you also don't want to put yourself in a situation where you give the insurance company a chance to even deny that claim, because if they happen to catch you during that time, during the first 2 years, you pass away, even post-mortem, they will underwrite you all over again and figure out if along the way they catch you in some kind of misrepresentation or misinformation on your app, they can deny the claim. And then your family loses out.
So, okay. So I was reading about excess death and what that was. What's excess death? I think excess death in terms of COVID, meaning, unfortunately, some like family pass away and they were in their 80s, right? And they died from COVID, right? A few family members. And I hate to say this, but it was a political argument and an argument for one of the sides where it's like, okay, we're looking at total deaths are 500,000, right? And there's like expected deaths that were going to happen organically, old age, flu, somebody who's from 89 years old probably is not going to, has a 50% chance to expire within a year for whatever reason, right? So they did they kind of said, hey, excess mortality, if you take that out, a lot of those people would have died anyway from other stuff because they were older, right? So what I'm getting at is I'm guessing of the 500,000 people, probably most, if not all, expired earlier when they were supposed to, right? I'm talking in terms of algorithms. I'm not talking about family, personal stuff. My heart goes out to anybody who lost anybody. But unfortunately, these life insurance companies are actuaries. So I'm guessing there's 500,000 policies that A, they stopped collecting for, and 500,000 policies B, that they had to pay out. I can't imagine that the actuaries are going to eat it and say, well, we paid out a little early. There's a pandemic. Great. Let's take it on the chin. I got a feeling they're going to push that forward towards higher policies. So do you recommend people maybe buy in now before they go up in 2022? The rate hike happen, or the rate hikes not happen? Rate hikes happen. I just want to know. A whole bunch of people died earlier. You guys are not going to, not you, big insurance companies are not going to take it on the chin. Have policies been raised? If not, should we get in now before they do? Walk us through the math.
Sure. So, the interesting part last year during the pandemic, what happened is the beginning, a lot of life insurance companies got scared, just like everybody else.
Yeah.
And there was a point where if you were 70 years or older, they were suspending all applications. You could not apply.
Wow.
Then they moved it to 65 and older at one point. That was like April, then May. And then by July, guess what they did? They said, hey, no restrictions. Anybody can apply, according to our guidelines. So if you're up to age 80, you can apply. They got rid of it because they're seeing the data come in over time. So realizing, okay, this is actually more in control than we thought. It's cool. We can just go ahead and start offering everybody life insurance again. And the mortality tables have been adjusted about 10 years ago. So what's going to happen is that regardless, every 10 or 15 years, they typically readjust what's called the mortality tables.
Correct.
So it's just interesting to see what's going to happen in the future if, in fact, they do include this pandemic with regards to the mortality tables. But we look at it on a historical point, although this was the biggest one we've ever had. A lot of these life insurance companies have been around for over 100 years. So you can imagine that some of the pandemics and viruses they've experienced over the past 100 years
should be baked in the numbers.
Yeah, they've been reflective. And so life insurance rates haven't necessarily been increasing over time. They've been slightly decreasing. But to your point, we can't guarantee that's going to be the same for the next 20 years. Could there be an adjustment? There could be. But I would say this is that life insurance is not the type of thing you also want to wait and see. It's like, well, let's wait. Let's wait. No, because you know what? If you're 45 now, 10 years from now, guess what? You're 55. Doesn't matter what the rate, what happens in the mortality tables. You're still 55 years old at that point. You're going to pay more. You're 10 years older. Yeah. So regardless, your age will change. The rates will change for you. So when you're young and healthy, get out of the way. Get it now.
Good point. So in short, though, because it was highly concentrated in New York and New Jersey, were there certain companies that I mean, that Berkshire Hathaway, New York Life, any companies that got particularly whacked because it was concentrated in terms of deaths on their financials in the books where they had a hardship or had to report poor earnings, or it didn't really affect the insurance companies? Not that it matters. They have their obligations and they got to pay. I was just wondering, was anybody disproportionately affected on the insurance side?
Actually, no. There were no reports of like excess claims or anything like that. I would say even from a local standpoint, Tom, crazy enough, one of the offices that I work with, it's based in White Plains. They had an office in Manhattan, no longer anymore, but That office in general has been around for a long time. And that particular office had 37 claims in 9/11.
Wow. Okay. Wow.
Okay. A lot of their advisors were working with a lot of the brokers from Cantor Fitzgerald.
Oh,
And they had 30. This particular office that I personally know, some of those advisors that are still around, had 37 death claims to the point where one guy had to get out of the business entirely because he couldn't deal with the level of psychological damage to him. So, but this time around, there was nowhere near the number of claims like that. I think they had like 3. So,
got it.
You know, so in perspective, there wasn't that much of a hit. And then also in perspective too, a lot of these carriers have a minimum amount of reserves anyway. So, you know, if they pay out even $20 million compared to where, you know, they're $1 billion in assets, it's we're talking about maybe, you know, half a basis point worth of loss.
Now, one last question, I promise.
Yeah.
But you have the military background, seen a lot of stuff, right? We're talking about death. It's not like hey, let's grab a cigar and talk about death, you know? But we are talking about death. As your military training and kind of background made it a little bit easier to talk about it, or maybe not harden you, but I don't know if I can find the right word, but has it made the conversation easier having a military background and being straightforward, having training and that kind of stuff to speak to it? Or is it still always a little tough?
I mean, I'd say it's right. I would say for me, my decorum with regards to my professionalism was definitely molded, and for me anyway, from my experience in the Marine Corps, right?
Yeah, he's never late, by the way. You hang out with him for a cigar, make sure you're on time.
If I am late, I'm going to call. Yeah, I call. Yeah, I'm going to be late. So, but then again, over time, my training just in the industry, I've learned how to tactfully approach the conversation without, I know it's a morbid topic, but we don't have to make it we can make it as morbid as we want or as soft as we want too. We can speak just matter of fact. We're talking about protection and that's it. And I've noticed that when people just look at it from that perspective, it makes the conversation easier. And also with my branding, you know, I think my content and everything, and I make it fun, and people like I just now getting intrigued with the subject, and they say, yeah, it's okay. Look, it's about putting the shield, putting that protection, right? Protecting your finances, because that's the mission.
Love it. Love it. I'm going to put a link. How can we find you though? If people
would love for people to follow me on Instagram if possible. So it's at life_insurance_mercenary.
Beautiful. I'll put a link below. Darwin, as always, thanks for coming on the New Theory podcast.
Absolutely, man. Glad to be back. Look forward to seeing you again.
Same too.